Half of all Americans who retired after 2020 have less than $90,000 in total savings. Not $90,000 short of their goal. $90,000 total. And the number that an entire generation of financial advisors handed you as gospel, the 4% rule, was quietly revised down to 3.7% by Morningstar in 2025. Meanwhile, the Social Security Trust Fund is now on track to run out in 2033, triggering an automatic 23% cut in benefits under existing law, with the Congressional Budget Office moving that date to 2032 in February of this year. 3 systems, all 3 degraded simultaneously. That's the actual story of retirement after 2020. Here's what I'm going to walk you through. The rules of retirement didn't just get harder. They got structurally broken in ways that are invisible until you run the real numbers, and by then, the decisions that matter most have already been made. I want to show you exactly where the breaks happened, why the conventional advice doesn't account for them, and what you'd actually have to do differently to make the math work in this environment. The metaphor I keep coming back to is the 3-legged stool. Classic retirement planning used to rest on 3 legs: Social Security, your personal savings, and 401k, and employer-provided benefits, either a pension or health coverage that bridged you to Medicare. For 2 generations, that stool held. It was sturdy enough that even if one leg was short, the other 2 kept you upright. But after 2020, all 3 legs got shorter, wobblier, or cracked at the same time. A 3-legged stool with 3 bad legs isn't a stool anymore. It's a hazard. And you don't notice it's a hazard until you sit down. Let's start with the leg that surprised the most people first. In a few minutes, I'm going to show you exactly what happens when the Social Security leg of the stool snaps and the specific year that matters for almost everyone watching this. But first, here's why the inflation leg of the stool is far more broken than most people admit, and why it's broken in a way that goes deeper than your grocery bill. 2021 through 2022, cumulative inflation peaked at 9.1% in June of 2022, the highest rate since 1981. By 2025, according to Consumer Price Index data, prices across the US economy were roughly 24% higher than they were in 2019. 24% in 5 years. To put that in practical terms, $1 you saved in 2019 for retirement, we only bought 76 cents of goods by 2025. That's not a rounding error. That's a structural problem for anyone whose retirement plan was built on pre-pandemic cost assumptions. But here's where it gets more interesting. You think inflation is a living expenses problem, that it makes groceries more expensive, and that's irritating. And yes, grocery prices alone surged 25% cumulatively between 2021 and 2023. But inflation in retirement isn't primarily about your grocery bill. It's about what it does to your withdrawal math, your portfolio behavior, and the decisions you make under pressure. Think about a couple who retired in January of 2020 with a planned budget of $50,000 per year. By 2024, that identical lifestyle cost them $56,000 to maintain, according to Bureau of Labor Statistics spending data. $6,000 a year they had not modeled. Over a 20-year retirement, assuming costs continue rising at even 3% annually, that planning gap compounds into a deficit that's not minor. The math that seemed solid in 2019 was quietly failing by 2023, and nobody sent an email. The traditional 4% rule assumes 2 to 3% inflation. The research that produced that rule was done in 1994 by financial advisor William Bengen, using historical market data from a period when inflation was tame. For 3 decades, the assumption held. Then 2020 happened, and the assumption didn't. And the more insidious version of this, almost nobody talks about. When inflation hit, people didn't just feel it in expenses. They reacted by pulling back on contributions. According to a Department of Labor report published in December 2024, 25% of employed adults decreased their retirement savings in 2022, specifically because of cost of living increases. Among Hispanic workers, that figure was 40%. So at the exact moment when market volatility was making portfolios worth less, people were also contributing less. The stool got shorter from both ends. Here's the reversal. You think inflation is the problem, but actually, inflation was the pressure test that exposed what was already missing. Any retirement strategy that requires steady 2% inflation to survive was never a robust plan. It was an optimistic bet dressed up in spreadsheet language. The bet lost. The pressure test revealed the weakness. And the weakness was already there. Pattern interrupt. The median retirement account balance in 2023 was $87,000. Not for people who never saved, for the median American who has a retirement account at all. Half the country with a 401k has less than $87,000 in it. Stay with me, because what I'm about to show you on the savings side is where the stool really starts wobbling. The recommended savings target 10 times your pre-retirement income, which is the standard rule of thumb, works out to roughly $572,000 for the median American worker. The actual median balance for people with a retirement account, $87,000. The actual average savings for people who have actually retired, $269,000, which is less than half the recommended minimum. Here's the number I want you to hold. Among people who retired in 2021 or later, people who crossed the finish line in the pandemic or immediately after, half of them have total savings of less than $90,000. $90,000. Those people are now living their retirement on a pool of money that generates, at 4% withdrawal, $3,600 per year from the portfolio. $300 a month. The rest has to come from somewhere else. And the somewhere else is Social Security. Which brings me to a parable. There's a concept in carpentry called measure twice, cut once. The idea is that precision matters before you commit to an irreversible action. There was a man in Ohio, we'll call him Ray, a contractor, spent 32 years on job sites, solid saver, retired in early 2021 with $200,000 in his IRA and a paid-off house. His plan was straightforward. The 4% rule gave him $8,000 per year from the portfolio. Social Security would cover the rest, and he'd be fine. What Ray did not model was 2022. The S&P 500 dropped approximately 18% that year. Ray's $200,000 became about $164,000 while he was simultaneously pulling money out to live on. He wasn't selling high and buying low. He was selling low and watching the portfolio shrink from both directions. By the time markets recovered in 2023, Ray had permanently locked in losses at the worst possible moment. That sequence of returns risk. It's the single biggest threat to any withdrawal plan, according to Morningstar's 2025 research. The order in which you earn returns matters enormously when you're drawing down, not building up. Earn great returns in years 1 through 5 and bad returns in 6 through 10, you're probably fine. Flip that order, bad first, good later, and the math breaks catastrophically, even if your average annual return across the full period is identical. And you have absolutely no control over which scenario you walk into on the day you retire. Morningstar's research found in 2025 that the safe starting withdrawal rate, accounting for forward-looking return expectations, not just historical data, is 3.7%, not 4. That sounds like a minor difference. It is not. On a $1 million portfolio, the difference between 4% and 3.7% is $3,000 per year. Over a 30-year retirement, $90,000. Now think about what that means for your required portfolio size. If you want $50,000 annually from your portfolio at 3.7%, you need $1.35 million, not $1.25 million. The gap is $100,000 you need to save before you can retire on the same income. And Morningstar's 2021 analysis, the one done at the bottom of the interest rate environment, found the safe rate was only 3.3%. It's bounced around based on market conditions. The point is, the floor was never reliably 4%, the formula was never meant to be permanent, and nobody told you. By the way, hit subscribe if you like the content, otherwise YouTube's algorithm may never show you my videos again. Knowing these numbers and actually building a system around them are two very different things. I learned that the hard way. I had a version of this data 3 years ago, and I still hadn't built the structure that made it actionable. So I spent a year compiling 50 years of retirement research into a mathematical framework. It's called the Exit Code. 8 chapters of actual research, no filler. The two things most relevant to what I've been describing. I go deep on the dynamic withdrawal method that replaces the 4% rule with something that adjusts to market conditions. So a sequence of returns disaster in year one doesn't permanently destroy a 25-year plan. And I cover what I call the $14,000 invisible bill, the pre-Medicare healthcare gap that shows up between age 62 and 65, that almost no retirement calculator accounts for because almost no financial advisor volunteers that number up front. You can get the full framework through the link in the description for less than 1 hour with a mediocre financial advisor. Every year you wait to understand this math, it compounds against you. Now, the forced exit. This is the one that hits people who think they've done everything right. This is where it gets really interesting. Before I show you why the Social Security leg of the stool is cracking and the specific timeline that makes it unavoidable for almost everyone watching, I want to talk about the hidden threat inside the savings leg. The one that starts with a phone call you weren't expecting. 60%. That's the share of people who retired early who didn't choose to do so. 60% of early retirees were pushed out by a layoff, a health crisis, age discrimination, or a family caregiving emergency, not by a retirement date they picked. According to ProPublica's long-form analysis of health and retirement study data, more than half of older workers experience an involuntary job separation in their 50s. And unlike younger workers who get laid off and find equivalent work within months, workers over 50 only rarely regain the income and stability they had before separation. The pandemic made this specific problem dramatically worse. Between 2020 and 2021, there were an estimated 2.4 million excess retirements caused by the pandemic. More than half of the 4.2 million people who left the labor force during that period, according to Federal Reserve Bank of St. Louis research. Some of those retirements were happy and voluntary. Many were not. Many were people in their late 50s who couldn't find equivalent work during the economic disruption, who burned through savings during an extended job search, who eventually stopped counting themselves as job seekers and quietly became retirees. The math on those retirements was not done in advance. It was inherited. Here's the trap that springs on forced retirees. When you're pushed out at 58, 3 things happen simultaneously that destroy the retirement math in ways that take years to fully show up on a balance sheet. First, your Social Security claiming decision gets poisoned. If you have no income and limited savings at 58, the pressure to claim Social Security at 62 rather than wait until 70 becomes almost impossible to resist. But claiming at 62 locks in a benefit that's roughly 50 to 55% of what you would have received at age 70. You don't just receive less money in year one. You receive that permanently reduced amount every month for the rest of your life, indexed to a lower base. If you live to 85, the cumulative gap between claiming at 62 and waiting until 70 can exceed $100,000 in lifetime income. Gone. Not because you made a bad decision in the abstract, because you needed cash flow and waiting was a luxury you couldn't afford. Second, the healthcare gap hits at the worst possible moment. Not 3 years of expensive private insurance before Medicare, 7 years, from 58 to 65. And as of 2026, with the ACA enhanced subsidies expired, a single person at 62 is paying roughly $1,072 per month just in premiums for a benchmark marketplace plan, according to Kaiser Family Foundation data. For a couple, over $2,000 per month. For 7 years, $224,000 in health insurance premiums alone, before a single copay. Third, and this is the one that doesn't make headlines, your 401k stops compounding forward and starts going backward. If you have $350,000 at 58 and you're drawing $12,000 per year from it to cover the gap, instead of growing to $515,000 by 65, it might only reach $380,000. The lost compounding on that 7-year window, the difference between what it would have been versus what it is over $135,000 permanently. The math doesn't reverse. There's a woman I read about in a Pew Charitable Trust analysis called Robin in the piece, who retired at 70 and then had to re-enter the workforce because the nest egg didn't stretch. She's not an outlier. Nearly a third of retirees are considering going back to work for the same reason: savings, not covering expenses. The dream of retirement, the vision of it, assumed the numbers were locked in. The numbers were not locked in. Your financial advisor, when you ask about the pre-Medicare healthcare costs and what to do if you get laid off at 58, well, you can always do COBRA for 18 months. Thanks. 18 months of COBRA, and then what exactly for the remaining 5.5 years? Now, let's put the stool back together one more time and talk about the leg that was supposed to be the stable one: Social Security. 78% of current retirees receive it. 91% of retirees over age 65. The average monthly benefit as of January 2026 is $2,071, according to the Social Security Administration's 2026 Cost of Living Adjustment Fact Sheet. For an aged couple, roughly $3,200 per month. That is real income. That is the floor most Americans are building their plan around. Here's a number that should be in every retirement plan right now and is in almost none of them. The Social Security Old Age and Survivors Insurance Trust Fund, the main bucket that pays retirement benefits, is projected to be depleted in 2033. That's 8 years from now. This comes directly from the Social Security Board of Trustees' 2025 annual report, released in June 2025. If Congress takes no action before that date, there is an automatic, legally mandated 23% reduction in benefits. Not a proposal, not a political threat. Under the current statute, benefits cannot be paid beyond what incoming payroll tax revenue supports. At the point of depletion, payroll tax revenue is projected to cover only 77% of scheduled benefits. The other 23% simply does not get paid. The Congressional Budget Office updated its own projection in February of 2026 and moved the depletion date to 2032, 1 year sooner, with the potential cut rising to 28%. The shift was driven by inflation, higher cost of living adjustments that are drawing the fund down faster, and new legislation passed in January 2025 that extended benefits to certain public sector workers, adding roughly $200 billion in new obligations over the next decade. Congress has fixed Social Security before. The landmark 1983 reform, a bipartisan deal under Reagan, raised the full retirement age, adjusted payroll taxes, and bought the program roughly 40 years of solvency. It can happen again, but the fix in '83 was done with time and political will. Maya McGuinness, president of the Committee for a Responsible Federal Budget, noted in June 2025 that lawmakers are now running out of time to phase in changes gradually and avoid harsh cuts. If Congress waits until 2032 or 2033 to act, any fix is either extremely abrupt, extremely expensive, or both. And here's the demographic math that makes the structural problem feel almost inevitable without significant action. In 1960, there were more than 5 workers paying Social Security taxes for every single beneficiary. Today, that ratio is roughly 3 workers per beneficiary. By the middle of this century, it's projected to fall to 2.5 to 1. The program is paying out more in benefits than it's collecting in payroll taxes. Since 2021, total costs have exceeded total income every single year. The trust fund reserves, which peaked at $2.91 trillion in 2021, are being drawn down. And right now, we're in what demographers call peak 6.5, the period from 2024 through 2027, when more than 4.1 million Americans are turning 65 each year. The largest cohort of retirements in American history, all drawing on the same shrinking pool. Congress, sitting in a room discussing Social Security reform. We should probably do something about this. Also, Congress, but not today, maybe next session. Someone schedule a committee hearing. Put the numbers together for a moment. A 50-year-old watching this video today will be 67 in 2042, well within their expected retirement years, when any cuts, if they come, would be in effect. If their anticipated Social Security benefit is $2,200 per month, and a 23% cut is applied, that becomes $1,694. The gap, $506 per month, $6,072 per year. Over 20 years of retirement, $121,440 of income. The plan assumed was there that might not be. And remember, this is also the group that will face the healthcare gap if they retire before 65, and the sequence of returns risk if they hit a bad market in their first 5 years. All three legs of the stool stressed simultaneously. Now you're asking yourself, okay, what does a realistic response to all of this actually look like? Let's run a specific case. This is a composite that represents a genuinely common situation among the audience for this channel. We'll call him David. David is 52 years old, earns $95,000 a year, has been contributing steadily to his 401k for 18 years. Current balance, $385,000. Plans to retire at 62, has a paid-off house, thinks he's probably in decent shape. Let me run this honestly. David's 401k, growing at 6% annually with continued contributions of $15,000 per year through age 62, reaches approximately $920,000 at retirement. At 3.7% withdrawal, the Morningstar 2025 safe rate, David pulls $34,040 per year from the portfolio. Add Social Security at 62, claiming early. Based on a projected full retirement age benefit of $2,200 per month, claiming at 62 gives him roughly $1,540 per month or $18,480 per year. Total retirement income, year one, approximately $52,520. Now subtract healthcare. David is retiring at 62, Medicare doesn't start until 65. In 2026, without ACA subsidies at his expected income level, David is looking at roughly $1,100 per month in marketplace premiums, $13,200 per year for 3 years, or $39,600 total before his first Medicare card arrives. That's not in most people's model. After healthcare, David's effective income in years 1 through 3 is about $39,000 on a lifestyle that costs $95,000 while working. He'll adjust. But the adjustment is more severe than he planned. Now, layer in the Social Security scenario. 2033, David is 60, just entering his retirement window. If the 23% cut materializes, his already reduced Social Security benefit drops from $1,540 per month to $1,186. The gap, roughly $4,200 less per year in perpetuity. And then the sequence of returns wildcard. David retires into whatever market environment exists in 2035. If the first 2 years of his retirement look like 2022, an 18% decline, his $920,000 becomes roughly $754,000, while he's still drawing $34,000 per year. The math compounds into a much tighter range of outcomes. David is not in crisis. He's a careful saver, but the plan has no buffer. The three-legged stool is resting on legs that are all slightly shorter than he measured. Here is a numbered framework, 3 levels of buffer that actually addresses this. Level 1 is the portfolio buffer. Build your required portfolio size, assuming 3.5% withdrawal, not 4%. Yes, it means working longer or saving more. But the difference between 4% and 3.5% on a required $55,000 annual draw is $157,000 of additional required savings. Know that number now. The people who don't know it find out at 63 when it's too late to change. Level 2 is the healthcare buffer. Model the pre-Medicare gap as a separate, explicit line item, not an afterthought. If you're planning to retire before 65, set aside a dedicated healthcare reserve equal to $12,000 to $15,000 per person per year times the number of gap years. For David, 3 years, 1 person, $36,000 to $45,000, sitting outside the main portfolio, not being drawn down for living expenses, specifically for health insurance. And given the subsidy cliff that went into effect in 2026, manage your modified adjusted gross income carefully so you can qualify for any remaining subsidy tiers. Roth IRA distributions don't count toward MAGI. Traditional 401k withdrawals do. That sequencing decision can be worth several $100s a month in premiums. Level 3 is the Social Security buffer. run your full retirement plan twice. Once assuming full benefits. Once assuming a 23% cut. If your plan only survives the full benefit scenario, you are exposed. The cut scenario is not a tail risk at this point. It's a base case without congressional action. And congressional action on Social Security has been historically inconsistent. If you need the full benefit to survive your retirement, the answer is delay claiming as long as possible, because waiting from 62 to 70 increases your monthly benefit by roughly 77%, and a 23% cut on a larger base still leaves you better off than a 23% cut on a 62-year-old's reduced benefit. But the whole point is, these aren't surprises. These are knowable. The data has been public for years. The trust fund projections have been updated annually in the trustees' report since before most people in this audience started their careers. The inflation math was always embedded in the 4% rules assumptions. The healthcare gap has existed since Medicare was capped at 65. None of this is new. What changed after 2020 is that all three problems became urgent at the same time, and the financial advice industry, which is largely compensated to manage assets rather than to optimize withdrawal strategies and model catastrophic scenarios, was not particularly incentivized to make this the centerpiece of client conversations. If you're in your 40s right now, you are in the highest stakes planning decade of your financial life. Not because the decisions are the most dramatic, it's not like you're buying or selling in one day, but because the compounding window is long enough that decisions you make now about contribution rate, healthcare buffers, and Social Security timing still have enormous room to matter. By your mid-50s, some of those levers are getting harder to reach. By your early 60s, you're mostly executing a plan you made earlier, for better or worse. The stool metaphor comes back here, as it always does. The three-legged stool doesn't need to be thrown out. It needs to be built stronger, wider base, thicker legs, and maybe a fourth leg, a buffer fund, a dynamic withdrawal system, a Roth conversion strategy that catches you when one of the other three wobbles. Because in the environment we've been in since 2020, assuming all three will stay solid simultaneously is not planning, it's wishing. 3 practical takeaways, calibrated specifically to this topic. 1. Recalculate your required portfolio size using 3.5% as your withdrawal assumption, not 4. If that number is larger than what you're on track to hit, that's important information to have now, not at 62. 2. Build a dedicated pre-Medicare healthcare reserve as a separate line item in your retirement plan, not folded into general expenses. Model $1,000 to $1,200 per month per person in premiums for however many years you plan to be pre-Medicare. And assume you're on your own, because as of 2026, the subsidy environment has tightened significantly. 3. Run your plan against the Social Security cut scenario before you sign off on any retirement date. Model a 23% reduction in your expected benefit. If that version of the plan doesn't work, your timeline or savings target needs to change. A plan that requires full Social Security is a plan that's betting on Congress. That's a bet with a specific published expiration date, 2032 to 2033, depending on which projection you use. The three-legged stool held for 2 generations. The legs are now shorter, the math is now harder, the timeline is now tighter. And the advisors telling you otherwise are usually the ones charging 1% per year to manage your assets and whose business model doesn't depend on you knowing the difference. Lazy investing built more fortune than crypto memes. And the financial planning industry that handed you the 4% rule without a single asterisk, without a single sequence of return scenario, without a single pre-Medicare cost projection, they're still fine. Their stool has 4 legs. Yours is the one you need to check. Those who retired in 2021 or later are in particularly difficult shape, with half sitting on $90,000 or less in total savings. Social Security's primary trust fund is projected to be depleted in 2033, and unless Congress acts, current and future beneficiaries alike will see their benefits cut by 23%. Morningstar's 2025 research found that retirees who experienced poor returns in the first 5 years and did not adjust their spending were far more likely to go broke. This is sequence of returns, risk in action. and it is the single biggest threat to any retirement withdrawal plan. Around 60% of early retirees are forced into retirement due to layoffs, health issues, caregiving needs, or age discrimination. Estimated average monthly benchmark premiums escalate to $1,072 at age 62, $1,101.80 at age 63, and top out at $1,120 for those ages 64 to 65. 79% of working age Americans believe the country faces a retirement crisis, up from 67% in 2020, according to a 2024 survey from the National Institute on Retirement Security.